Welcome, everyone. I'm Mike Felix, and I head up marketing at Omega Point. I'd like to thank you for joining today's webinar, Creating Custom Hedge Baskets, the first webinar in our Best Practices in Hedging series that takes place every Tuesday at 11:30 a.m. to noon through the last week of October. Just a few short notes regarding today's presentation. We anticipate we'll have some time at the conclusion of today's presentation to answer any of your questions. During the presentation, you can submit your questions by going to the GoToWebinar control panel on the right-hand side of your screen, click on the Questions tab, and that sends them directly to our presenters, and we'll address and answer those once the presentation concludes. Also, once we process the recording within the next day or so, please look out for an email that includes the recording of today's webinar, as well as a PDF copy of the presentation deck. The email will also give you the opportunity to reserve some time for a more customized one-on-one demo of Omega Point's hedging capabilities, or its wide variety of other use cases, including portfolio construction, rebalancing and optimization, and you can explore some recently added features, such as adding your own custom data sets to analyze your portfolios, and a lot more. So now that the housekeeping is out of the way, on to our main event. It's my pleasure to introduce your presenter today for Creating Custom Hedge Baskets. That's Alex Flournoy, Omega Point's Head of Product Specialists. Alex works hand in hand with our clients in their portfolio construction workflows and risk management strategies. So without further ado, I'd like to hand it over to Alex.
Awesome, thanks, Mike. Hi, everyone. I'm excited to welcome you to part one of our webinar series on best practices in hedging. As Mike mentioned, the first webinar in our series is going to be focused on constructing an optimal hedge basket. Today, we're going to cover a couple of areas. The first is what is hedging and why you should use it. The second will be running through custom hedging versus out-of-the-box alternatives. And lastly will be a checklist for custom hedge design, so you can actually employ the best practices that we walk through today. So let's start with the basics. What is hedging? Hedging is really the technique of reducing or transferring risk. And ultimately that translates to being able to reduce your market risk. So for example, if you have a macro perspective that a given market is going to head into recession, you might want to short that specific market. Or you might have a more micro view on a given asset that you think may have positive alpha, but is in a sector that you don't like. In this case, you can short that asset sector to hedge the sector risk out and keep the long asset's alpha risk that you have positive conviction in. The key here is to transfer risk away from broad bets that you have less control over, such as the market, sectors, or factors, and push it towards calculated risk that you have conviction in taking. Here's an example. Let's say that I'm a US large cap manager and I manage a best ideas portfolio. I have a lot of conviction in the alpha names in my portfolio, but I think that the US is going to head into recession. While I can't change my US mandate, I can use hedging to short this market and reduce my bets on the US as a whole, and instead focus my performance on my alpha. So again, here I'm showing my US large cap portfolio in purple on the left. And then I have two hedged examples where I'm hedging the SPY by 25% as well as by 50% in green and yellow respectively. What we see is that the total return of my unhedged portfolio is around 18%. And my hedging does shave off some of those returns, with my 25% hedge yielding 15% return and my 50% hedge yielding just under 12% return. However, on a risk-adjusted basis, I'm actually gaining a higher reward per unit of risk as measured by the Sharpe ratio. So you can see as I increase my hedge, I'm actually increasing my Sharpe ratio from 65 basis points in the unhedged portfolio to 84 basis points in the 25% hedged portfolio, and over 100 basis points in the 50% hedged portfolio. I'm also seeing much lower volatility across the board as I increase the amount of hedging. So again, the hedging is going to provide more efficiency for us and allow us to focus more on having a desirable risk profile. We can also look at this from an ex-ante risk perspective. So what I'm showing here is, again, for my large cap portfolio, as well as the 25% hedged version and the 50% hedged version, the total risk over time from the beginning of the year until the end of September. In blue is the SPY as a comparison. So we can see that the total level of risk for my US large cap portfolio is around 30%. And then comparing that to the two hedged versions, which have much lower risk, we can see that the hedging here is reducing the overall predicted risk of my portfolio. But not only am I reducing the overall risk, I'm actually shifting this risk to more desirable places. So here again in purple, I can see the factor risk in my portfolio is around 88%, and the hedged versions of my portfolio have much lower factor risk, coming in around 84% for the 25% hedged version and 75% for the 50% hedged version. Thinking about this another way, we can also say that I'm shifting the risk in my portfolio to specific risk. In other words, I'm boosting the alpha conviction that I have in this portfolio. So ultimately, hedging allows us to transfer risk to more desirable places, away from factors that we have less control over and towards specific risk or alpha that we're able to apply our convictions to. In those examples, I was using the SPY to hedge the portfolio, which appeared to do a relatively good job on the surface. But if we dig a little bit deeper, we can see that I was actually introducing some unintended bets into my portfolio. Here, what I'm showing is the SPY ETF from 2007 until now, and I'm looking at the volatility exposure using the Wolfe Research QES US Broad risk model. What we can see is that SPY is consistently underexposed to the volatility factor. I can also look at another interesting factor, the short interest factor, and see that SPY is also consistently underexposed to the short interest factor. You might not think that this is a big problem. Being underexposed to these factors is typically a good thing. However, these factors have very heavy negative premia over time. So by going short an ETF that has negative exposure to these factors, I'm actually going long these factors. So in this case, if I was using the SPY as a hedge, I might be hedging out the overall market risk of my portfolio, but in reality, I'm actually introducing a massive unintended bet and going long volatility and long the short interest factor over time. We can take a look at another example, another popular ETF that's used for hedging, which is the QQQ. In this case, we see the same trend. QQQ is consistently underexposed to volatility and consistently underexposed to short interest. So again, we're actually going long these two factors that typically have very negative premia over time and are going to introduce unintended bets in my portfolio. My examples on SPY and QQQ were really focused on unwanted factor exposures, but there are several other issues that can arise when using standard ETF hedges instead of custom hedges. Here I'm showing a stoplight chart to help identify these issues, where green identifies characteristics that are very easy to achieve, yellow identifies characteristics that are sort of achievable, but maybe not easy or straightforward, and red identifies characteristics that are just not achievable at all. And what we can see is that down the line, custom hedging allows us more flexibility across all of these characteristics, whereas with using out-of-the-box hedges or ETF hedges, it's sort of mixed results. With custom hedging, we're able to trade any name or any asset class that we desire, incorporate any custom mandates or custom alpha outlooks that we have. We can more effectively hedge market and factor risk or sector risk even. And we can also incorporate ex-ante risk into our hedging in order to minimize our tracking error or our volatility. Ultimately, we can avoid what we want to avoid and incorporate whatever we want to incorporate. And lastly, we can rebalance anytime. So if the hedge starts to decay or is no longer meeting your goals, you can just rebalance the custom hedge. Whereas with ETF hedging, you either need to change the ETF that you're using or you need to wait for the ETF to rebalance itself. So here it's clear that custom hedging allows a lot more flexibility than hedging with out-of-the-box instruments. So after walking through the benefits of creating custom hedges, you might wonder why this hasn't become an industry standard sooner. There are three main reasons. The first of which is technology. Until recently, the technology available to construct, manage, and maintain custom products was just simply not widely available. However, now we're seeing a democratization of technology that allows us to support custom hedging with ease. The second is the rise of alternative data sets, which can cater to very specific investment theses and allow you to incorporate your convictions in more creative and more specific ways than ever before. And lastly is the increasing demand for robust risk management. Asset owners are consistently demanding a higher level of sophistication in the risk management practices of asset managers, and ultimately asking more complex questions that need more complex ways of answering. We believe that custom products sit squarely within the cross-section of these trends, and that the rise in using custom products for portfolio construction is only going to become more prevalent. So now that I've convinced you how awesome custom hedging can be, let's talk about the actual logistics. Before diving in, it's important to design a checklist. And I liken this to something as simple as going grocery shopping. Would you ever go to the grocery store without having a written list first? Well, if you're like me, you probably have in the past. And if you're also like me, you probably kicked yourself afterwards because you spent so much time going up and down every single aisle, looking at all of the options, only to leave the store remembering later that you forgot something that you needed. Well, we definitely don't want this situation to occur when building a hedge. You don't want to put on a hedge and later remember that you forgot to incorporate something that you needed. So it's imperative to create a checklist and ensure that you check everything off during the construction so that the hedge actually meets your goals. And this can be broken down into three easy steps. The first is to define your trade universe. The second is to determine your optimization constraints. And the third is to iterate on the hedge construction so that you can gain comfort with the hedge and ensure that it's meeting your goals. So let's walk through that first step on the trade universe. There's an infinite number of ways to build a hedge. And while an optimizer is going to do a lot of the heavy lifting for you, as we'll show over the next couple of weeks, part of the art of a good hedge is knowing what choices to make for the optimizer and what choices to leave to the optimizer. So it's certainly part art and part science. So with the trade universe, the first question that you want to ask yourself is, do you have an outlook on your hedge universe? If you do have an outlook, this could translate in a couple of different ways. Maybe you can incorporate your stock rankings or price targets or other internal research to identify negative alpha names. Remember that we're going short the hedge. So if you have conviction that a certain group of securities is going to perform poorly, those are great candidates to include in your hedge universe. Maybe you take this up a level and you think about it from a sector, industry, or even a country perspective. It's great here to incorporate any industry or sub-industry convictions, and you can even do so at a very low level, like I said, at the sub-industry level, so that you avoid large sector bets. If you don't have an outlook on your trade universe, that's okay too. In this case, you'll want to start with a relatively broad universe. A larger universe is going to result in a more diversified hedge that'll have less of a chance of having a positive alpha name that will drive up the performance of your hedge, or in other words, drive down the performance of your hedge, because again, we're shorting these names. It's also important in this case to screen out any securities that have high stock specific or extreme exposures. If you're not intimately familiar with the universe that you're using, then you want to avoid situations or minimize situations where you could have a positive alpha name in your portfolio. And typically, stocks that have high specific exposure or high extreme exposures of the factors are good contenders for positive alpha names. So it's always good practice to screen those out. Other considerations to take are thinking about things like liquidity. So you certainly want to make sure that the securities in your hedge are liquid names so that in case you need to cover the hedge quickly, you can do so with ease. Hard to borrow is another consideration. You can use short interest data, or your broker can provide a list of hard to borrow names, and you can just exclude those from the trade universe at the beginning. Earnings risk is something to keep in mind. You'll want to remove names that have upcoming earnings within the hedge period to avoid the earnings pop and again, have a positive alpha event occur in your hedge. And lastly, you should think about removing any secondary listings so that the optimizer isn't loading up on the exact assets that you're trying to hedge. Let's see this in practice. Here I'll walk through an example where I'm trying to hedge a long position in Nikola. I've already screened my universe here for hard to borrow names and names that have potential upcoming earnings risk. I have a particular outlook in this case. Though Nikola is technically in the machinery industry, I actually think that based on the products that Nikola makes, that automobiles may be a better hedge. I also think that automobiles are not likely to be a high alpha industry during my hedge period, So I'm going to use not only machinery for my hedged universe, but I'm also going to incorporate the automobile industry as well. I don't know these industries deeply well, so I am going to screen out names that have extreme specific risk, in this case, lower than 70% specific risk, so that my hedge doesn't suffer from any type of idiosyncratic event. I also want to make sure that my hedge has very liquid names in case I need to cover it quickly. So I'm using a screen to screen for highly liquid names using the Wolf risk model liquidity exposure as a screen. I'm not going to build it into this hedge, but if I had any ESG perspectives or other types of mandates that I wanted to incorporate, I can certainly plug this in as well by using custom content or integrated content, like I said, as screens to incorporate these mandates. So now that we've created the trade universe, let's determine our actual optimization constraints. So the first thing to consider are things like hedge sizing. If you're making a pure alpha play, then you may want to consider a full hedge to dampen the factor risk and really boost the alpha of the name that you're hedging or the group that you're hedging. If instead of a pure alpha play, you really more want an insurance policy to make sure that you have some backup in case your convictions are incorrect, then you may consider a partial hedge. And here we would say that your conviction should really inform the hedge sizing. Next, we want to think about our asset constraints. In this case, more is typically better. So more names in the hedge can create a lower chance of an idiosyncratic event driving hedge performance. Most hedge baskets start at anywhere from around 15 to 25 names, but can go up much higher than that and be in the hundreds of names realm. So this again is really up to you and should be based on the conviction that you have in the hedge that you're building. You also want to avoid high concentration, which kind of goes back to the number of names that you have in the hedge. In this case, unless you're doing a pairs trade, a single name really shouldn't be driving the hedge performance, or even a couple of names. And you also want to consider market impact. You don't want any position in your hedge that exceeds about 5 to 10% of average daily trading volume. Again, we want to make the hedge easy to cover and easy to trade. And then lastly, you want to consider any factor constraint that you want. Most often, you're going to be using the hedge to neutralize core portfolio factor bets or to ensure that you don't have any overall portfolio tilts from a factor perspective. So you can use the hedge to target risky portfolio factor exposures and create a net neutral tilt to a given factor. The goal here is that you really want to let your alpha shine and neutralize the impact from factor bets. Okay, so let's go back to our Nikola example. Here we want to ensure that we're comfortable with the top names in our hedge, the sector and industry bets that we're taking on, and other various tilts that we may be taking on with the hedge. When I originally ran this hedge, the concentration was much higher than I was comfortable with. So I actually ended up imposing various constraints around the concentration, the number of positions, and the trade size as a percentage of ADV. I also made sure to target a neutral volatility exposure because I don't want to take a factor view using this hedge, going back to our earlier examples that I walked through on SPY and QQQ. After tweaking the constraints, I now have a hedge that I'm actually willing to trade. I'm happy with the industry exposures that I'm taking on with this hedge, and I'm happy with the various names in the hedge as well as the level of concentration that I have. Now that I have a hedge that I'm actually comfortable with from a construction standpoint, I now want to evaluate the hedge to make sure that it's doing what I want from a risk standpoint and meeting my various goals. And I can see that this hedge is doing exactly that. Remember that the goal here was to neutralize the factor bets that I'm taking from this trade in Nikola, and instead focus on the specific risk that I'm taking on from this trade. If we look at the very right-hand side of the screenshot, in green is the combined trade of Nikola and my hedge. I can see that the total risk of this trade, around 31.11%, is lower than the trade of Nikola individually, which you see in blue on the left. I can also see that my combined trade has a much higher specific risk, over 70%, and also is increasing Nikola's specific contribution, again, also 70%. So in this case, my hedge is doing exactly what I want it to do. It's neutralizing factor risk, and it's boosting the alpha in this trade. Once the hedge is built, the next step is to iterate on the hedge and then back test it to ensure that it withstands changing market environments and continues to meet your goals over time. We're going to cover this back testing and simulation of the hedging strategies in next week's part 2 of the webcast series. We hope to see you there.
Thank you, Alex. Well, that concludes the presentation portion of today's webinar, but we've had a number of your questions already come in, and it's not too late to submit any additional questions, and you can do that via the tab, the questions tab in the GoToWebinar control panel on the right-hand side of your screen. So now we'll open up the remaining time in today's webinar to Q&A.